Welcome to the next episode of Small Business Legal Tips. I'm attorney Mark Bross of Bross LLC. Today we're going to talk about a decision that many entrepreneurs face when they first start their business, whether to form their business as an LLC or as an S-Corporation. This is a huge decision. It has an impact on almost all aspects of your business. It impacts what type of entity you form, how your business is going to be managed, how profits and losses are going to be distributed to the members or the owners of the business, how the business is going to be taxed, and what kind of ongoing compliance you have in connection with the business. As a practicing small business attorney, I've helped countless clients choose the right entity structure for their business. In this video, I'll explain what a limited liability company is, what an S corporation is, the differences between them, and some factors you want to consider when deciding which entity is best for your business. And please, if you'd like to get more helpful tips from us, please hit the subscribe button below and ring the bell so you get notified the next time a video is posted. Now let's get to it. So what is an LLC? An LLC, which stands for Limited Liability Company, is a type of business entity or business structure that you form under the statute of a particular state. In Massachusetts, the statute is MGL 156C, but if you live in a different state or are trying to form your LLC in a different state, the statute will be particular to the state where you're at. These are very popular entities with entrepreneurs because they are what are called hybrid entities. And they're hybrid entities because they combine the best features of partnerships with the best features of corporations while trying to eliminate the drawbacks of each of those two different types of entities. One key feature of the LLC is that it offers limited liability protection to the owners of the LLC, which are called members. And what this means is that generally speaking, the personal assets of the owners of the LLC are shielded from the debts and liabilities associated with the business. The only personal assets of the owners that are at risk are the personal assets that they contributed to the LLC when the LLC was first starting out. Other than that, generally speaking, the assets should be shielded from the debts and liabilities associated with the business. And this is like a corporation, but it's unlike a partnership where the personal assets of partners are always at risk for the acts of the other partners in the business. The second key feature of an LLC is that they are extremely flexible in a wide variety of ways. One way in which LLCs are flexible is in connection with the owners of the LLC. Generally speaking, there are no restrictions on who can be a member of an LLC or as to how many members there can be. So that means corporations, trusts, partnerships, foreign individuals, U.S. citizens, and any other type of entity can, generally speaking, be a member of an LLC. A second way in which LLCs are flexible is with respect to the profits and losses of the business. Generally speaking, LLCs can choose to distribute their profits and losses in any way they see fit. So what that means is that an LLC can distribute its profits and losses in proportion to the ownership of the business held by each member, or it can choose to distribute them in some other way. A third way in which LLCs are flexible is with respect to management. They can choose to be member managed, manager managed, or they can choose to have a corporate structure by having officers and directors. The sky's the limit, and LLCs can choose to be managed in any way they want to. Another way that LLCs are flexible is taxation. LLCs can be taxed in a wide variety of ways. They can be taxed as partnerships, sole proprietorships, and corporations, whether C or S corporation. It all depends on the number of members of the LLC and the filings that the LLC has made with the IRS. Despite the tax flexibility of the LLC, the default taxation for an LLC is as a pass-through entity. This means that the profits and losses of the business are reported on the member's personal tax returns, and the LLC does not have to pay its own federal income tax by filing its own tax return. Another key feature of the LLC is that there are few statutory requirements that need to be followed by the LLC in order to comply with the law. In Massachusetts, there are only two requirements. The first is that you need to file a certificate of organization. The second is you need to file your annual reports. And that's it. An LLC should also have an operating agreement, but it's not technically required under Massachusetts law, and you wouldn't be violating the law by not having one. So let's move on. What is an S corporation? An S corporation is a special type of corporation, also known as a small business corporation, that elects to pass through its profits and losses to its shareholders so that they report the profits and losses of the corporation on their personal tax returns. This avoids the double taxation of C corporations, which get taxed both at the corporate level and also the individual shareholder level. For S corporations, there's only one level of taxation, and it's at the shareholder level, who have to pay for the profits and losses of the S corporation. However, as a corporation, an S corporation has all the benefits and drawbacks of corporations. The benefit of a corporation is that it provides limited liability protection to the shareholders. As long as all the corporate rules are followed and all the formalities are followed, the personal assets of the shareholders are, generally speaking, shielded from the liabilities and debts associated with the corporation. The drawback is that all corporation formalities must be followed by an S corporation in order to remain in compliance with the law, and there are a lot of rules that need to be followed. A corporation has to have officers and directors, and the officers have to be a president, a treasurer, and a secretary or a clerk. Corporation also has to have bylaws. Corporation also have annual meetings of shareholders and directors. And at the annual meetings of the shareholders have to appoint the directors. And at the annual meeting of directors, the directors have to appoint the officers. There have to be minutes of these annual meetings, and minutes need to be kept in a corporate book. And the corporation has to file annual reports. If you don't follow these formalities, then you run the risk of having the corporate veil pierced, which means that the personal assets of the shareholders can be potentially at risk for the debts and liabilities of the corporation. The corporation becomes an S corporation by filing an election with the IRS known as Form 2553, which I believe is called Election by a Small Business Corporation. In addition to the regular corporation requirements, S corporations also have strict requirements that need to be met in order to qualify as an S corporation. And this includes strict ownership requirements where there can't be more than 100 shareholders of an S corporation. The shareholders have to be natural people. So you can't have corporations, partnerships, LLCs, or certain types of trusts can't be shareholders of an S corporation. The shareholders have to be U.S. citizens or permanent residents of the U.S. and various other requirements. So there are strict ownership requirements in order to qualify as an S corporation. Additionally, an S corporation can only have one class of stock, which means that all shareholders must be paid distributions at the same time and in the same amount in proportion to the number of shares that they hold. This means that if the corporation wants to make distributions to the shareholders, it's got to make payments to each and every shareholder in proportion to the number of shares that they hold and in the same dollar amount. Given all these requirements, you might be wondering, what's the point? Why bother being an S corporation? Aside from avoiding double taxation, a primary reason to set up an S-Corp is you get some tax benefit if you pay yourself a reasonable salary. The tax benefit is you only pay self-employment tax on the reasonable salary, and any other distributions from the S corporation are taxed at your capital gains rate if they're taxed at all. So this can lead to a significant benefit by only paying self-employment tax on your reasonable salary. So let's compare each of these two entities directly. Take a look at this chart, which goes through various features, and so you can see the differences between each of the two entities. So if you take a look at the first row, you'll see we're talking about taxation. And this is how the entity is being taxed. And with the LLC, you'll see the great flexibility you have there. And it really doesn't even capture all the flexibility you have. But with an LLC, you're going to be taxed as a pass-through entity unless you decide to be taxed as a C corporation. And the reason why I say it doesn't really capture all the flexibility you have is because LLCs there's even flexibility among the type of pass-through entity you're taxed. So if you're a single member LLC, the default taxation is you're going to be taxed as a sole proprietorship unless you elect to be taxed as an S corporation, in which case you'll be taxed as an S corporation. For a multi-member LLC, the default taxation is going to be as a partnership, which is pass-through taxation, but you can also elect to be taxed as an S corporation too. So there's great flexibility in how an LLC can be taxed, which you can see under this column. With respect to the S corporation, there's only one option. S corporations are going to be passed as a pass-through entity, and there's no other election to be taxed in any other way. The second row, you'll see also we're talking about self-employment tax. And on this, you'll see one of the downsides of the LLC, which is that with respect to the LLC, you pay self-employment tax on all profits. However, you also see some of the great flexibility with the LLC too, which is that if you elect to be taxed as a C corporation or an S corporation, you're not going to have to pay self-employment tax on all the profits. If you're an LLC that elects to be taxed as an S corporation, you're only going to pay self-employment tax on the reasonable salary. And for a C corporation, it doesn't even have to be a reasonable salary. You're just going to pay self-employment tax on the salary. But then, of course, you're also going to be double taxed as a C corporation. And under an S corporation, you'll see for self-employment tax, you only pay self-employment tax on the reasonable salary, but you don't pay self-employment tax on any other profit distributions from the S corporation. Under the next row, you'll see paperwork formalities, and you'll see again the LLC has minimal paperwork and formalities, which we discussed before. In Massachusetts, the only formality you have to follow is filing a certificate of organization and the annual report. Whereas for an S corporation, you have a lot of formality to follow. You have the regular corporate formalities of having officers, directors, shareholders, annual meetings with all of them. You have to keep minutes for them. And you also have to have bylaws. And of course, you also have to do all the payroll stuff. But you also have the formality associated with being an S corporation. Which also adds to it more. And on the next row, you'll see some of that. So you'll see ownership flexibility. Again, for LLC, it's very high, as we discussed. And that means anyone can be a member of an LLC, unless you're an LLC that elects to be taxed as an S corporation. So corporations can be members, partnerships can be members, trusts can be members, associations, U.S. citizens, non-U.S. citizens, anybody you want can be a member of the LLC as long as it's reflected in your documents. With an S corporation, on the other hand, you'll see it's very rigid in terms of who can be owners. The only people who can be an owner are natural persons or natural people, and you can only have 100 shareholders, and they have to be U.S. citizens or permanent U.S. residents. Now, though, as I said, they have to be natural people, there are some exemptions there where some kind of trust can be a shareholder of an S corporation, but very few. And also a corporation could own a shareholder, but it has to be a wholly owned, qualified S corporation subsidiary, which is a topic for a whole nother video. But generally speaking, S corporation has very rigid rules as to who can be owners. And you've got to think it can only be natural people, and they've got to be U.S. citizens, and you can only have 100 no matter what. Next row, management flexibility. You see again, LLC, you'll see the great flexibility. You can set up any type of management structure you want. Manager managed, member managed, corporate structure with presidents, officers, and directors. Anything you want to do. It's all okay under an LLC. Again, as long as it's usually reflected in an operating agreement, but it even doesn't have to be. S corporation, you are very limited in your management structure. You have to have officers and directors. And the officers, you have to have president, treasurer, secretary, or clerk. Although the clerk could be called secretary, depending on what you want. You can have more managers than that, but you got to have those three in order to be in compliance with the statute. The next row, you'll see profit and loss flexibility. And again, you'll see LLC, you have very high flexibility. It's very high because you have a lot of flexibility with LLC. You can distribute profits and losses in distribution to the ownership of the company, but it doesn't have to be. You can also distribute profits and losses to one member because they paid more money and you want to repay them first. Or you can even separate profits and losses and distribute losses to one member, but not to the other. It just all depends. You have great flexibility with the LLC in terms of how profits and losses are distributed. S corporations, you have absolutely no flexibility there. It's very limited. Profits and losses have to be distributed in proportion to each shareholder, and it's got to be the same dollar amount for each share because that's the requirement of having a single class of shares. If you would distribute it in any other way, the IRS could find you have two classes of shares and dissolve your S corporation status and treat you as a C corporation, which nobody wants. All right. So now that we've gone through and compared each of these two entities, why would you want to be an LLC? Generally speaking, there are a few reasons why you'd want to choose to be an LLC. The main reason why you want to be an LLC is if you value or want flexibility. As we've seen and discussed, LLCs have a lot of flexibility in a lot of different ways. So if any of that flexibility is appealing to you, then LLC is your entity, and that's the one you want to choose. The second reason why you might want to choose to be an LLC is if you have owners who are not natural people or not U.S. citizens. So for example, if one of your owners is a corporation or an LLC or a trust, you have to be an LLC. Or if you have more than 100 shareholders or more than 100 owners of the business, you have to be an LLC. You can't be an S corporation at all. And if you have any owners who are not U.S. citizens, then you also have to be an LLC. In those cases, in those situations, you absolutely cannot be an S corporation because it's not an option because they can't be shareholders of S corporations. The third reason why you want to choose to be an LLC is if you don't want to deal with corporate formalities. As we've seen, there's lots of rules that you need to follow if you're a corporation. You've got to have officers, you've got to have directors, you've got to have annual meetings with shareholders and directors, and all sorts of other things that need to be followed if you want to maintain your entity. LLCs have almost none of those rules. So if you don't want to deal with any of the corporate formalities, then you should be an LLC. Now, I've seen a lot of misinformation online where it suggests that if you're an LLC taxed as a corporation, you still have to follow all those corporate formalities. And that's simply not true. If you are an LLC that's taxed as a corporation, you don't have to follow all the corporate formalities. So you don't have to have officers and directors. You don't have to have annual meetings. You don't have to have bylaws. You don't have to have any of that stuff if you don't want to. However, if you are an LLC taxed as an S corporation, you still need to follow the S corporation rules. So you still have to only have a single class of shares, and you can't have more than 100 shareholders. That's part of what means being taxed as an S corporation. So although you're avoiding corporate formalities, you still have to follow the S corporation rules if you're an LLC taxed as an S corporation. But a main reason to be an LLC is to avoid corporate formalities. So let's do the flip side. Why would you want to choose to be an S corporation? And there are a couple of reasons why most businesses choose to be an S corporation. The most common reason to be an S corp is if the business earns enough to pay its owners a reasonable salary and wants to save on self-employment tax. Now, I'm often asked, well, how much is enough for the business to earn when it makes sense to be an S corp? And I've heard different figures from different accountants. Some accountants I've heard have suggested that the business should earn more than $100,000 before it makes sense to be an S corp. I've heard other accountants have suggested less. So if you're thinking about being an S corp, I would say speak with your accountant who knows your tax situation as to what makes the most sense as to whether to be an S corporation. The second reason why you'd want to be an S corporation is if you want profits and losses to be distributed equally and proportionally among each of the owners of the business. As I mentioned before, an S corporation has to do this because it's only allowed to have a single class of shares. LLCs can do this, but it often requires a more complicated operating agreement in order to specify exactly how profits and losses should be distributed. So if you know up front that you want profits and losses to be distributed proportionally and equally among all the shareholders, then it makes sense to just be an S corporation because it's easy. It's easy to do it. Another reason for choosing an S corporation is if you want to obtain outside investors. Although LLCs can take on outside investors, it's often much more complicated and difficult to do so. In S corporations, it's much easier to take on outside investors, although it's much more restricted in the number and type of investors you can take on. A C corporation is by far the easiest way to take on outside investors, but then you're going to be subject to double taxation and the hassle of running a C corporation as opposed to an S corporation. The next reason for setting up an S corporation is that it is less expensive to operate an S corporation than it is to operate an LLC taxed as an S corporation. Now, this may only be a Massachusetts specific thing, but in Massachusetts, the filing fees associated with an LLC are significantly more than the filing fees associated with a corporation. In Massachusetts, the filing fees associated with an LLC are $520 to form the LLC, and then $520 each and every year for the annual reports. To form a corporation in Massachusetts, the costs are $275 when you form it, and then the annual report each and every year is $125. So it costs a little more to be an LLC taxed as an S corporation than it does to be a straightforward S corporation. Now, this might all balance out given the cost of maintaining the corporate formalities of an S corp, but it's at least something to consider. Now, while we're on the topic of LLCs and S corporations, here are some mistakes to avoid in connections with these entities. The first common mistake to avoid is paying yourself too little as a salary in connection with an S corporation or an LLC taxed as an S corporation. The salary you pay yourself must be a reasonable salary. And this is something that the IRS pays very close attention to, and they look at and they commonly investigate to make sure you're paying yourself a reasonable salary. Now, the obvious question you have is, well, what constitutes a reasonable salary? And as with anything with the IRS and the tax codes is complicated, generally speaking, a reasonable salary is one that's comparable to what other businesses are paying, given the duties and responsibilities you're performing, how much time you're spending, the financial condition of your business, the type of business you are. Lots of other factors go into it. Consult with your accountant to see what salary you should pay yourself and what would constitute a reasonable salary given the type of business you are. The next common mistake to avoid is forgetting to change your operating agreement. And this is for LLCs that decide to become taxed as an S corporation after previously being taxed in some other way. When most LLCs start out, they decide to start out with their default taxation, and their operating agreement reflects that. So for single member LLCs, that would be taxation as a sole proprietorship. And for multi-member LLCs, that would be taxation as a partnership. However, when they decide to become taxed as an S corporation, many of the provisions of the operating agreements are inconsistent with being taxed as an S corporation. The most common problem is having provisions in the operating agreement that allow for profit and loss distributions that are inconsistent with having a single class of stock that you need to have in order to qualify as an S corporation. And this is something that the IRS has looked at. And in the past, it has avoided the election to be taxed as an S corporation because of provisions in the operating agreement. So if you're an LLC that's deciding to be taxed as an S corporation, make sure to amend your operating agreement to remove any provisions that are inconsistent with being taxed as an S corporation. The next common mistake to avoid is ignoring the formalities of the entity, whether it be an LLC or a corporation. The reason why you don't want to ignore the formalities is it can lead to all sorts of problems, including dissolution by the mass division of corporations and possibly piercing the corporate veil. And if either of those occur, the owner's personal assets are at risk, and they can be held personally liable for the debts and the liabilities associated with the business. So don't do it. If you're an LLC, make sure and file your annual reports timely each and every year. And if you're a corporation, make sure and hold annual shareholder and director meetings and file your annual reports every year. So let's give a quick recap of what you want to consider when trying to decide between LLC and S corporation for your business. LLCs are less formal and more flexible. They're good for businesses that don't want to deal with formalities and want to keep their options open. S corporations are more rigid and formal. They are good for businesses that earn enough money to pay the owners a reasonable salary and also can deal with the ongoing compliance requirements. And don't forget, with the flexibility of the LLCs, you can start with the default taxation for the LLC and then choose to be taxed as an S corporation in the future in order to get the tax benefit. Thank you so much for watching. If this helped you, please hit the like button and the subscribe button in order to receive more helpful tips for entrepreneurs. If you have any questions, please drop them in the comments below, and I'll see you next time.